All right, welcome back to Talk Tickers. Today we're diving deep into CSW Industrials' fiscal Q3 earnings, which dropped on January 29th. Now, this was a really interesting one because the company's in the middle of a huge transformation, but the market, well, its reaction was pretty immediate and, frankly, pretty brutal. So let's break down what actually happened and what it all means for the stock going forward.
Okay, so here's how we're going to tackle this. We'll start with the quarter at a glance, then get behind the headlines. After that, we'll dig into guidance and management's tone, figure out the big takeaway for investors, and finally, we'll give you our take on the next call. Let's get into it.
All right, first up, the quarter at a glance. Let's set the stage with the headline numbers that really moved the needle.
Okay, so this table pretty much tells the whole story in a nutshell. You look at that revenue number, right, up over 20% year over year to $233 million. On the surface, that looks fantastic. But here's the kicker. Wall Street was expecting something closer to $250 million. And then you look at the adjusted EPS, it came in at $1.42. The street was looking for $1.90. So a big miss there, and it's actually down more than 21% from this time last year. That's a double whammy right there.
And bam! This is what the market thought about those numbers. The stock got hammered, dropping almost 8% on the day, and it was on heavy volume too. This wasn't a quiet little dip. Investors saw those misses and headed for the exits. This reaction, right here, is really the anchor for everything else we're going to talk about.
So now we have to ask why. Let's go behind the headlines, because this quarter was really a tale of two competing stories.
And this is the absolute core of the issue. It's like they're trying to fill a leaky bucket. On one hand, they're pouring in tons of new revenue, almost $1 billion worth from acquisitions. That's how they get that flashy 20% growth number. But on the other hand, their original organic business has a leak. It's actually shrinking, down almost 3%. And the biggest leak is in their Contractor Solutions segment. That's down over 5% because of what they call destocking. All that means is their distributors are clearing out old inventory instead of placing new orders. So the new stuff looks good, but the core business is showing some real cracks.
And just to put that in perspective, look at this chart. That Contractor Solutions segment, it's not just a part of the business, it's practically the whole business, making up a massive 71% of their revenue. So when that part of the ship takes on water, the whole thing starts to list. It's the engine room, and right now that engine is sputtering. So it's not just about sales. The other thing that really spooked investors was the profitability, or lack thereof. We're seeing some serious margin compression here. Both their gross margin and their adjusted EBITDA margin got squeezed, dropping 170 and 250 basis points respectively. In simple terms, they're making less profit on every dollar of sales than they were a year ago. And a big part of that is the mix of businesses they bought and, of course, other cost headwinds. Now, this is really interesting. On the call, management kept trying to get everyone to focus on EBITDA. But the market wasn't having it. Investors were laser-focused on the bottom line earnings per share. And why? Because all those acquisitions were funded with debt. That means interest expense shot up by $10 million, and you got higher amortization too. All of that eats directly into profits, and that's the EPS dilution story that investors were reacting to so negatively. Okay, so that's the what happened. Now for the what's next. Let's talk about guidance and try to read the tea leaves on management's tone. So management tried to paint a pretty optimistic picture for the future. They came out swinging, saying they're actually going to beat their synergy goals from that big Mars acquisition. They also dropped some hints about encouraging order volumes in January, and made sure to remind everyone that the comparisons get a lot easier from here on out. They're basically saying, hey, we know this quarter was rough, but we've got this under control. And this quote right here just perfectly captures the vibe of the whole call. Cautiously optimistic. You hear that phrase a lot in earnings calls, and it basically means things are looking a little better, but please don't get your hopes up just yet. They're confident about their long-term plan, for sure, but they're being really cagey about when that organic demand is actually going to bounce back. They see some green shoots, but they are definitely not ready to declare that winter is over. The analyst Q&A was super revealing, as it always is. They basically confirmed the destocking problem is nearing an end, but the timing is still a big question mark. Interestingly, they also pointed out that all these new businesses they bought have made the company's results more seasonal, with Q3 now being their weakest. And here's a big one for strategy. They're in a digestion period. That's Wall Street speak for we're done shopping for a while, they're going to focus on what they've bought, which they said will last for quarters, not years. All right, let's pull all of this together. So what's the big takeaway for investors trying to figure out what to do with CSW right now? Well, this chart says a lot. It's not just that CSW had a bad quarter.
It's that they're having a bad quarter while the rest of their neighborhood is throwing a party. The broader industrial sector, which we're using XLI as a proxy for, is up almost 19% over the last year. CSW? It's down almost 9%. That is some serious underperformance, and it just highlights how skeptical the market is right now.
So it all boils down to this. CSW is officially a show-me stock. The talk is done. Investors are now waiting for proof. What's the proof they need? Two things. First, they need to see that organic demand, especially in HVAC, is coming back for real. And second, they need to see those profit margins start to expand again as the synergies they keep talking about actually show up in the numbers. The risks, they're pretty obvious. If the housing market stays weak, that recovery gets pushed out. And if it takes them longer to get their arms around these new businesses, that margin recovery could be a slow, painful grind.
And that brings us to the final section, the next call. Here's our prediction and our official rating on the stock.
Okay, here's our three-part call. First, for the next quarter's outlook, don't expect fireworks. We're predicting modest organic growth at best, as those destocking issues probably linger a bit. The story's going to be all about integration and synergy. Second, what's the stock going to do? We think it's going to be stuck in a range, pretty much treading water until investors see hard evidence that the organic business is turning and margins are improving. And third, our rating. We're calling this a market perform. Look, the long-term vision of what they're building is pretty compelling, but that's balanced by some very real, very significant risks in the short term.
And of course, we have to say it, this analysis is just for your information. It is definitely not financial advice. Please do your own research.